So they say that the only interesting thing to come out of Belgium was Tintin. Fred Destin, I think, is the exception to that. Originally Belgian, then became a prolific VC, big deals at Axel. He's invested in a whole bunch of very big companies, Zoopla, PillPack, Deliveroo. And then last year, he got together with Harry Stebbings, who I think defines the word precocious. Was it 15 years old your first proper business started?
Yeah, it was 15.
Okay, yeah. He's now 22.
22, getting older.
He has probably the leading media outlet dealing with the VC world. It's a podcast called 20 Minute VC, which gets access to everybody and millions of downloads. And the thing about Harry is he's built the world's best social network around himself because he keeps in touch with all these people and they all respect and want to be on the program. And what we're going to do now is generate a podcast of 20-minute VC with these two talking to each other, which I hope will be your most trafficked episode. Harry and Fred.
So this is a very special one. I've done 2,500 episodes, and I've never done one live, so we shall see how this one goes. But I do want to start today, and there's going to be lots of energy for the final session, so have no fear there. But I want to start today, Fred. You were at Excel, one of the leading funds in the world, and you left to start Stride. Tell me, what was the thinking and the thesis behind that?
Yeah, so I think there are two primary reasons. One is my sense of mission is around seed, and I love nothing more than a company with 5 to 10 people where the options are open and the future is there to be written. I was also somewhat terrified at the idea of having to return 3-4x a 500 million fund, to be honest. And I'd much rather be on smaller funds that we keep constrained by design so that we can really hopefully deliver to our investors return that are more attractive than I think what the larger funds are trying to do. So if you're Excel or you're Index, you're fine because these are the top brands in Europe. But if you're a tier 2 VC running a $500 to $800 million fund, it's extremely hard to actually provide the kind of returns that really venture demands. So small is beautiful.
Agreed, small is beautiful. But I want to start then. Obviously, you tried investing in early stage startups. Startups traditionally viewed as this kind of inherently risky proposition. I want to start on that. How would you respond to the notion of startups as this risky proposition, so to speak?
Well, startups are risky, but I think there is a misconception sometimes that we hear from LPs about how risky venture capital is in terms of risks that you're really going to lose all your money. Mm-hmm. Maybe it's informed by the 90s and the bubble, but the reality is if you invest with a certain level of discipline across 25 companies, you own enough of them, 10, 12, 15, 18%, you're actually really looking at a relatively spread risk and with odds of certainly returning a multiple of capital that are pretty good. And so I'd much rather be investing at seed where we can really control capital outlays over time than maybe putting all my money into public equities in the US today. So I do think that at a portfolio level, people tend to overemphasize how risky a venture capital is. I think where they do have a risk is on duration. When are the returns going to be realized? Because it's, as we know, it's easy to invest, it's extremely hard to exit.
Mm-hmm. I do want to start then on that element because, I actually spoke to Brian Singman at Founders Fund the other day, and he said that startups are a game of upside maximization. And so kind of latching onto that element of risk, how do you think about that kind of upside investing, and then how does that correlate to maybe a view on loss aversion?
Yeah, so I think we are completely schizophrenic as venture capitalists because at the beginning we have to do a lot with very little. And so we're in this mindset of don't spend your money, don't hire too fast, keep the burn low. And then there is a point where you have to flip and say, actually, there's enough here that's working that we should go for it. And I remember having this conversation with TJ Parker at PillPack. And TJ, we were at 5,000 patients for our online pharmacy, and TJ sort of thinking, hey, I want to put a plan together where we get to 50,000 patients for next year. And my question back to him was okay, what would 250,000 patients look like? What does it take from an organizational standpoint if that's really what we're trying to hit? Because the thing is, if you never put yourself in the mindset of trying to get to those numbers and get to those outcomes, you never will. So this is not a question of throwing money at the wall and hoping it's magically going to stick. It's more a question of forcing yourself to think of exceptional outcomes kind of early enough in the life of the company so that you can actually put yourself on a trajectory where you're going to hit them. And this is why the Americans are so much better than anybody else, because they've lived it. And for me, having lived through Zoopla's at 3 billion, PillPack's at 1 billion, etc., like once you get to these outcomes, you suddenly start to realize, actually, there is a system to do this. You can systematize your thinking around achieving large outcomes, and it's more a question of your own mental limitations than usually the businesses themselves.
I have to ask, you said about knowing when to scale there. That's slightly off schedule, but have to do it. You said about knowing when to scale. I've interviewed a lot of founders, and there's the common notion that once you have unit economics that are sustainable and look healthy, that's the time you pour fuel on the fire, so to speak. How do you think about this, and is that a fair assumption?
So this is an interesting point, because a lot of, I would say, more traditional investors are very obsessed with unit economics that work. And you're sort of saying that is the test of validity of a business model, is having unit economics that work. There's only one problem with that theory. We would never have funded Deliveroo. We would never have funded PillPack. In fact, Kareem probably would never have taken in any capital, because you have to project yourself into sometimes a 3 or 4 year cycle before these unit economics really come to bear. And so I honestly don't think that there is any form of, you can't apply a recipe to startups. You have to be mentally plastic, look at each case individually, and I think this notion of once unit economics work, we can then scale, would lead you to probably miss 3/4 of the world's best opportunities, frankly.
Mm-hmm. I do want to finish on the theme of risk and ask, in terms of acceptable versus unacceptable risks to take, when assessing an opportunity for you, are there certain ones which you view as, concerning but willing to take versus it's a non-negotiable? How do you think about that?
Yeah, the first thing I would say is, as with my partner in the fund, I absolutely hate taking founder risk. We always say, so there is a difference between saying, I'm going to back someone who's smart and who's capable and who's got relevant domain knowledge, or saying, I'm looking for founders who can really reshape their industry. And the way I put the bar really high is by saying, are you the kind of person who I think can reshape an industry? If you're sitting in the room with Jeff Bezos at Amazon and you're trying to get $200 million more out of your exit price, are you the kind of person who can do that? And I really don't like taking founder risk, because I hate replacing founders. When you replace founders, you lose the magic, and I think it's actually extremely valuable to our companies. The other thing I really don't like to take is market timing risk. So I've learned over time as a VC to make myself dumber. Do not try and be smarter than the market. So look for things that you can scale within the horizons that you can control, which is why, for example, maybe I'm wrong, but I haven't done a ton in VR, because I find it insanely difficult to predict when that market's really going to take off at scale. And so I don't like market timing risk. Now, by contrast, give me as much market risk as you can, because if you're going to build big companies, you got to go after markets that are sometimes risky, unproven, etc. And I'm happy to take a lot of that. And I don't mind taking a lot of execution risk. Because PillPack, for example, is a complex business with pick and pack and high-speed verification of packets and robots. But I think as startups, we have the ability to assemble exceptional teams, and I actually think we can outcompete on execution and on operational complexity. So that I don't mind as much, because that's how you create value.
Again, really unfair of me. I have to ask, just picking up on a few of those, you said there about the founders and being able to sit in a room with Jeff Bezos and negotiate for 200 million more. Is there a way to stress test that pre-investment? It's a limited time one spends with a founder pre-investment. Is there a way to really determine the fabric of them as a person pre-investment? And the same could be applied when assessing managers, I guess.
I mean, it's an acquired skill for me. I wouldn't say that I was particularly good at it early in my career, because I tended to think everybody was great. Because I'm naturally a positive person, so I wanted to give money to everybody. I'm like, this is what you're doing is fantastic. Let me fund you. What I do now, which is, it's not a trick, but I start the work of building the company like in the second meeting. So instead of sitting back and listening to a pitch and formatted information, it's like, let's map out the organization. Let's think about your go-to-market challenges. Let's think about how you conceptualize pricing. And so instead of being in this give and receive mode of info and me trying to make a decision, I'm like actually doing the work with the founder. And I don't have a problem actually engaging fairly hard, sort of challenging assumptions, or pushing a little bit the boundaries of what's comfortable, because I'll also find out what we're going to be like in a case of conflict. This is like dating, and everything's wonderful, and then first time you do the dishes together, you're throwing them around the room. Well, find a disagreement with the founder before you invest, because your conflict resolution mode is important, and actually the person's reaction to conflict or to pushback is also important. So this is what I try and do. I don't think there's a particular hack for it. I think gut and experience really helps too.
You also said about market timing. Immediately makes me think, I spoke to Peter Fenton the other day at Benchmark, and he said he always laughs when he hears investors say they look for big markets. I'm sure we've all heard that before. How do you think about that? Is that a fair assumption, and what's the response to his suggestion there?
So I'm very much in the same school of thought. I think your ability to assess markets either bottom up or top down at the beginning of the life of a new company or a new segment is extremely hard to do. And very often because the legacy industries are unattractive. So I tend to discount that and focus more on really understanding either the product experience you're delivering or the problem you're solving, and whether it's really valuable to someone. And I tend to almost, I wouldn't say completely discount, but I don't look that much at market size. What I do look at though is, can you build a strategic asset? In other words, are you going to control the relationship with the customer? Are you going to be a really valuable company within your space? Why? Because if you're not strategic, nobody has to buy you. If nobody has to buy you, as a VC, I'm going to sit on that position for 12 years and end up selling it secondary to a horrible, secondary buyer who's going to take a 40% discount on my book value. So I do look for assets of a strategic nature in markets that matter, but I don't try and be too smart about understanding the future 5 years out and how big the markets are going to be.
Mm-hmm. You mentioned legacy industries there, and kind of another form of risk that we often see is posed, there's such large incumbents in the space, how are we going to navigate that? And when we spoke before, you mentioned the word organized chaos. Can I ask, can you unpack that, and maybe how organized chaos relates to the relationship between startup and incumbent?
Yeah, so I'm constantly fascinated by the fact that we put together companies with few engineers, with limited resources, and they do reshape industries. PillPack is a company that got acquired by Amazon for $1 billion. Guess how many engineers they have? 45. This is a tiny engineering team that built a pharmacy operating system, which the incumbents have supposedly spent $500 million trying to build over 7 to 10 years, and we did it in 3 with a team of 50. And so how does that work? Well, companies are all about execution, speed of execution, quality of decision making. By definition, we live in chaotic environments. And what I mean by chaotic environments is you can spin up services on the cloud right away. You can enter new markets incredibly fast. You can measure everything you do at speed. Capital flows globally. And so your ability to plan is zero. So what you have as a startup actually is an ability to make decisions in conditions of uncertainty faster than anyone else. And by the way, these decisions are never perfect. What you're playing for is batting average. If you're the CEO of a company, you make important decisions all the time. The easy decisions have been taken by your team, right? If you've delegated properly, you never see them. So all you end up doing is taking hard decisions about complicated problems on which you have limited data. That's why it's hard to be a company founder, because that's what ends up on your desk every day. And so what you have to do is really take decisions fast and have a sort of failure mode as your default mode. We make decisions, we make a mistake, we learn, we adapt, we iterate. And so chaos is part of it. Now, to embrace chaos, the other thing you have to do is not to fossilize or to structure your organization too much. So HubSpot in Boston was famous for not having any titles for the longest time. They had titles externally, because clients care, or you're executive vice president or whatever, but internally, actually, they refused to have a structure of titles. Why? Because they were constantly re-engineering the company. The way you run yourself at 20 people is not the same way you run yourself at 100 and at 300. And notably, these days, if you look at product organization, they're not siloed product organization. People create cells around specific issues they're trying to solve, and then they iterate these cells. When the work is done, they dissolve them and they create new cells. Right? So I think you're looking at that as a form of organized chaos, and actually you accept chaos is an inevitable part of the process, which means if you're a planner, you're in trouble. because you really can't plan long term. You're constantly iterating your team, your business, your go-to-market, your pricing, just everything's constantly shifting.
Okay, so if you're a planner, you're in trouble. Yeah, I've spoken to maybe 1,700 VCs, and they often define company performance by ability to hit a plan. Is that a fair assessment? Is there an alternative, better assessment? How do you think about this kind of maniacal focus on did you hit the plan?
Okay, so if you want to see me transform into the Hulk, you put me in a board meeting where somebody's bashing an entrepreneur for missing numbers. Couple of reasons. So if you think as a VC that the entrepreneur didn't obsess about meeting the numbers before you came into the room, you're an idiot. That he or she probably lost sleep over it for weeks, number one. Number two, what are you trying to do? Are you trying to destroy the social contract with somebody who's working their ass off day and night by making them feel worse than they already feel? Like, what's your objective? So I think people get confused between, I want a culture of delivery inside the organization, delivery with doing things fast, getting shit done, as people say in startup land. But what I have no interest in is whether you're actually hitting the plan. The plan is a fiction. The plan is a framework for which to think about the future. The moment you finish writing it, the conditions change, etc. In fact, even worse, if you force a company to hit plan, and they're not hitting plan naturally, you're probably making the wrong decisions for the business long term, right? Maybe you had a plan that was predicated on selling into financial services and government, and maybe your financial services initiative is failing. So what you should really do is assess whether you get product market fit in financial services, and even whether you should sell into that vertical. Instead, you're going to bash the entrepreneur and say, you said you'd deliver $3 million in financial services, go do it, right? So this is why it's a fallacy.
No, I love that answer. I do want to touch on the element of, actually, it was discussed in the Sovereign Wealth Fund entrance discussion earlier today, and it was kind of innovation in the venture ecosystem. As we heard, there hasn't necessarily been a huge amount over the period, but we've seen more and more over the last few years. How do you assess maybe innovation in the mechanics and the model of venture that we have seen over the last 5 years?
Right, so there are different styles and types of VC, and so the way in which you will engage with the entrepreneur has to be authentic to your own style. So I'm a company builder. Typically, I like to recruit, I like to look at strategy, I like to be in the weeds of company building. The two major innovations we've seen is one is the sort of networked model of venture capital. So the idea would be, why don't I deconstruct access to cash and separate it from access to advice and talent, right? Because at the end, VCs are assholes, nobody likes them, they're arrogant, they don't deliver anything. So why don't we separate the cash from the network, and we create YC or AngelList. So AngelList, the original vision of AngelList, because Naval hates VCs, was why don't I separate the skill set here between people who are good at investing and people who would be good advisors, and I'll break it open through a network. YC goes almost a step further, which is YC can operate without investing partners, because they plug you into a network of alumni, and the network is the value. Right? So now we almost have a ghost in the machine type of venture capital firm where we're fully distributing both the decision-making of investments and the support towards the company. So that's number one. And then number two, of course, is Andreessen Horowitz. The badass operators who come into venture and say, nobody in venture is a true operator. So we are going to build an operating company to help build startups. And so, half or more of the organization is recruitment. They're very famous for putting you in touch with the corporate world, corporate buyers, etc. They literally cycle thousands of large corporations through their office every year, meeting all their portfolio companies. So they've industrialized and hardened that model. And these are basically have been the two main disruptors to what is a fairly traditional industry. And then, the boutiques continue to operate well. So you'll see USV and Foundry and Benchmark continue to operate extremely well. And you have basically two models, which is one is the boutiques, the other one is kind of what I would call the investment banks, which is structured, hierarchical, very industrialized, like an Insight or people like that. So we've seen a little innovation coming. I think there's more coming with data, and I think today there's one person who spoke about that.
Yeah, no, I want to touch on the data element, because obviously that's another theme that we've seen, kind of people claiming and suggesting they're using data intelligently to source new opportunities. If you were to kind of switch sides of the table almost and put on the LP hat, what are the core questions that you'd be asking? What are the considerations when evaluating kind of the utility value of data at this stage of market?
Yeah, so I think there's quite a bit of FUD around data. And let me talk about when it's used, I think, well, and when I think it's a bit, people are sort of kidding themselves. So if you look at the public equities market, they get more efficient by 3 to 5% every year, roughly. And they're driven by, massive investment in data and technology. So somebody told me Two Sigma will invest $5 billion into their technology and data infrastructure. So just let that sink in, $5 billion, hundreds of PhDs, coders, etc. Right? So when you look at our world, there are areas where it's obvious you can use data at scale. So your friend Ryan Colbeck is trying to build a programmatic fund to invest in consumer goods companies, CPG companies, on a global basis by using data. Now, he would be the first to say, I can do this because the business models are predictable, repeatable, the margin structures are pretty much always the same, and I can measure the efficiency of marketing in always the same way. So that is a logical place where you can come in and disrupt, quote unquote, traditional venture capitalists by doing this on a global basis, data informed, and it's both finding the companies, identifying investment opportunities, assessing them, and then helping them as well after, because you can benchmark on a global basis what excellent performance looks like. Now, then you have people who come into seed stage and they say, oh, I'm going to run large-scale queries on LinkedIn and I'm going to score founders and all that stuff. I'm like, okay, that's great. That's probably vaguely helpful in terms of finding new deals. But the quality of signal that you derive really doesn't help you that much in terms of making investment decisions. Our business models are too varied. Half the time we don't have any data at all anyway. And so I think that the notion that data is going to disrupt early stage venture fast, to me, is somewhat exaggerated, because we did some of that work at Accel. It is insanely hard to derive signal from the very fuzzy nature of the early stage data we get.
Among the differing models, though, so much innovation in venture actually, and there's the traditional notion that venture is a game of stock picking. With the changes that we've seen, I actually spoke to Jeremy Liu at Lightspeed the other day, and he said that there's an added dimension to this element of stock picking. How do you think about stock picking and whether it's still relevant today in this climate?
Well, so I think for the everyday entrepreneur, getting access to capital, is like the number one concern, right? So not everybody has choice. My only recommendation, which I always tell entrepreneurs, is please don't ever take money from assholes. You cannot fire your board members. It is probably not worth it in your life in general. I'd rather not get funded than take money from people who are toxic. I think it's something that is worth thinking about very hard. Now, if you are one of these founders who does have choice, so you're Will Shu at Deliveroo, for example, well, when I spoke to Will Shu at Deliveroo, there were 20 people in the company. It wasn't as early as what we usually do, but he had 7 term sheets on the table. So, you don't win it on price, actually. You win it by looking the guy in the eye and saying, I believe in your mission, I'm actually in love with your business, I'm on your side, and meaning it, you kind of have to feel it, and then being a partner along the journey and making the person on the other side feel that that's true. Because you're not selling the deal at that point, you're selling the person. And so to phrase that a different way, we have to get picked. And which means we need there's brand and all that stuff, but we also need the ethos and the mode of operation so that people pick us. And again, you can't fake that. Obviously say, oh, we're founder-friendly. You can't fake founder-friendly. Founder-friendly means I will leave my fear at the door of the boardroom because I will come in and do the right thing by the company. Not by my partners, not whatever, I get roasted at the fund level because the company isn't doing well. Well, I will leave all that baggage at the door, and when I come through the door, I will do the right thing by the company. And living that every day through the career of a venture capitalist is not that easy, actually. So I think we do have to get picked, and to get picked, we have to authentically care about the mission that our companies, the journeys that our companies are on. Mm-hmm.
You said it's not always about price there, and we've seen an influx of capital almost like never before, and there's a lot of concern around pricing in many cases. Peter Fenton at Benchmark said on the show, never turn down a deal based on valuation, it's a mental trap. How do you assess maybe your own price sensitivity when evaluating new opportunities?
Well, if you're across the life of a fund, if you're not disciplined on price, it will make your life a lot harder. It is important in general to act with some form of price discipline. Now, if you say no to a world-class deal because the pre-money is $3 million off what you thought it should be, you're an idiot. because world-class deals don't come through your door every day. And fundamentally, I agree with Peter. But I think we have to take what he says with a pinch of salt. In fact, I bet you Benchmark gets discounted pricing on most of what it does because they're Benchmark. And I've definitely gone into negotiations saying in fact, Deliveroo is a good example. We are not going to match the other prices. I'm sorry. I'm not going to go up to the level of people who are desperate to get in and are competing based on price. I don't compete based on price. I think the price has to be fair. The price has to be slightly uncomfortable for me, which is probably the sign of a good compromise. But I'm not. If it becomes a game of trying to optimize every clause, and that takes precedence over choosing your partner, your investor partner, that tends to be a super negative signal for me, which is like, wow, you're the kind of person who tries to game the system for the last point of ownership. That makes me somewhat uncomfortable. So I respect the fact that people play the game of negotiation. I think that's fair. But if they're trying to get you to climb up a tree and kind of make their ultimate selection based on a couple of $1 million of pre-money, that to me is usually a signal that you're a short-term optimizer and not somebody who's going to build an amazing business.
Okay, so in this situation, you agree on price and sign the term sheet and you join the board. Moving to that element of the board then, what do you think are the maybe 1, 2, or 3 things where a VC and a board member can really drive strategic, positive, actionable help in the board setting that maybe kind of you've experienced and you've seen in market?
Yeah, so the notion of venture value add is very elusive, and people talk about it more than they deliver it. And I would say the best entrepreneur, like Alex Chesterman at Zoopla, for example, the best entrepreneur is someone you don't really need to help. Like, I don't need my ego stroked. I don't need to be a crutch to someone. If I don't add value to my entrepreneur because he's doing amazingly well, that's great. At the very least, I can be somebody he's happy to celebrate with his own successes, right? That would be sort of the baseline. Now, I don't apply any recipes ever to anything that I do, so the value add is almost entirely dependent on what the company is facing. I would say typically what I try and do is help the entrepreneur focus and simplify what they're focused on. Because if the job of the CEO is to define the vision, that process of defining the vision and deciding where to focus is actually pretty hard. So I would say I'll spend a lot of time when people are faced with 1,000 choices and they're down in the weeds to help them, take their head out of the water a little bit, look at the long-term implications of what they're doing, and say, look, there are 7 or 8 things the company's engaged with that we can probably kill. And how do we come to the right decision collectively about where to focus and what not to do? So I'd say I spend half my time telling people what not to do so they're more efficient at the stuff that actually matters. And then I spend a ton of time recruiting. Because for me, see, if I look at a team and they're not performing, but I like the team, I'm like, okay, there's somebody missing on the field. Usually that's the answer. So I'm like, okay, here are the people that are around the table. We're missing, we need a very strong product manager. So what's the most valuable thing that I can do that has the most leverage? Is go recruit that person. I'm actually pretty good at recruiting. I love it. I've done a lot of it. So I'll go with the CEO and we'll do the screening, the selection, et cetera, together because I think that's actually valuable. And then I love storytelling. And so I think helping companies and founders move from, sometimes they know too much about their industry and they forget the essence of their brand or the essence of their story, or maybe even the authentic story that they were telling at the beginning that resonated and it sort of gets diluted over time. So I always try and help people reconnect with stories that kind of make sense to the market, make sense to the company and feel authentic, and then turn that into marketing messages that they can actually use. Why? Because if you're the CEO pitching me for an hour, I'll have a lot of time to understand what the business does. If you're the 2-level down sales guy that's been hired in the last week and comes out of 7 years at Salesforce, he needs to be able to carry the message with the same level of conviction and clarity as the founder. So if we're able to distill the essence of a brand and the marketing and commercial messages down to a level where that new hire out of Salesforce in Kansas City can do as good a job as you today in Dubai as the founder of the company in carrying the message across, that's highly valuable. Why? Because again, it's a leverage exercise. So I always look for maximum points of leverage in what I do.
So if that's the good, and the final question before we move into a quick fire round, if that's the good, flipping sides, what does a dysfunctional and maybe less effective, less well-functioning board look like?
So a lot of boards in venture are dysfunctional. And in fact, it's getting better, but I would say at some point, maybe 10, 15 years ago, it was almost a default mode of a board to be dysfunctional. The companies would spend 2 days preparing giant slide decks The whole management team would grind to a halt, because there was so much prep work to be done, and the VCs would say, I want a product review, a sales review, a marketing review, a finance review, and these things were giant. They were giant productions. And so I think we've moved more to a world where we're like, look, let's keep reporting to a minimum. We didn't come here to hear the weather report as to whether it was raining or not last month. We're here to make important decisions that help the company move forward. So I think that the dysfunctional boards tend to be reporting boards where there is distrust with the entrepreneur, usually because they don't spend enough time with the company, and or they lost the empathy of understanding what journey the company is on, and or they underestimate the complexity of what the company is trying to do, and they're not patient. And so you create distrust over time. The entrepreneur gets more and more defensive, may not feel comfortable exposing the weaknesses of the company proactively. And if you do that for 2 years, at some point, the investors start to whisper amongst themselves, oh, this founder, we can't trust the founder. Founder's lost it. And then maybe we hire a VP sales who's doing badly because we don't have product market fit. We fire the VP sales, and the next guy at the door is the founder. And you get into these relatively logical, vicious circles over time that are usually driven by an initial breakdown in trust. And so, again, your job is to create conditions in which an entrepreneur comes and says, these are all the things that are wrong about the company today. These are the reasons why we're going to fail, and help me solve them. And I think a lot of VCs look back and said, you're not hitting the plan that we agreed on, instead of saying, let me look forward and say, how do we make this a better company? And trust your founder until you don't, or trust your CEO until you don't. If you're backing the CEO and he's running the company, it is your job to be behind the CEO. If at some point you make a decision to remove the CEO, make a decision to remove the CEO. What you're not allowed to do is be like a fucking carpenter ant that's like destroying the house that the people are living in, right? So that's what a lot of people do.
It's funny, I asked Brad Feld at Foundry, and you don't even know this, I asked him advice pre-joining a board the other day, and he said exactly that. If you're behind the founder, you have to be behind them 100%. But I do want to dive into a quick fire round now. So essentially, I say a short statement, so starting on your favorite book it will be, and then Fred will give me his immediate response, about 60 seconds per one, and I will be strict on you. I have a timer in front of me. Okay, so favorite book, Fred, and why?
So I'm an avid reader. I normally say The Master and Margarita, but today for change, I'll go with Man's Search for Meaning by Viktor Frankl. And the reason why is because it's basically a book about his experience in concentration camps and maintaining oneself of decency and humanity in the face of unspeakable suffering. And there's a lot of learnings about life in general. And the key learning is by giving, and by being focused on others, even in the most appalling circumstances, you protect your humanity. And I think we can just apply that generally, especially given the world we live in today.
Really unfair question for 60 seconds. What does the rise of AI mean for jobs?
Yeah, so I have a major concern, I have to say, about the speed at which the transition will happen. And if we actually would say, forget AI for a second, just focus on workflow automation. We can take out 60 to 80% of white-collar jobs through smart workflow automation before we're even touching decisioning engines like AI. So, insurance, claims processing, banking, customer support, call centers. So imagine for a second that you have a call center, we have a state-aware voice responder that basically is able to have complex conversations with you. Man, we can take 80% of what you're doing with a call center person today without fixed menus all the way down to resolution and pass you to a highly trained human at the very end of that process. So call center industry, boom. Claims processing industry, boom. And that's before we even talk about AI. So I think workflow automation, machine learning, analytics are going to create a displacement in jobs that I think would accelerate, and it is concerning to me.
What do great venture partnerships look like?
Well, I have a simple answer to that. We need to seek the truth together. And so it is a collective exercise in making better decisions. And in particular, actually, if you look at you and I, and we talked about this with Danny Reimer the other day, we have to watch a bias towards repeating the kind of stuff that's made me successful in the past. In other words, we have to avoid playing to a tune that we already like. But in fact, constantly seek to correct our biases in decision making. So the way I like to do this is through a policy of really radical intellectual honesty, which, by the way, you can apply to your your personal relationships. Is a great way to live in general, which is whenever something bugs you or is wrong, talk about it right away on the fly and talk about every minor issue. In fact, there are no minor issues. If I said something to a founder that irked you, talk to me about it. And that way, we will maintain a culture of honesty, openness, transparency, where we are trying to make each other better. And when it comes to making investment decisions, we will try collectively to come to the right decisions. And the last thing to say on that is, having failure in portfolios is normal. It is par for the course. And in fact, and we use this poker analogy all the time. In poker, you can, I don't actually play poker, so I'm going by second-hand reading here, but in poker, you can make absolutely all the right decisions and still lose. Well, the same is true in venture. So you can make investments where you've made absolutely all the right assessments and the company still fails. Was that a bad investment? Was that a bad decision? Actually, maybe not. And so these biases work every which way. You know, success is not an indicator of future success, and failure, in fact, you can take an investment type that failed, do it again, and have a massive success on your hands. So it's complicated, and it takes mental agility, the spirit of a beginner, and I think a lot of discipline around forcing yourself to be intellectually honest all the time.
Okay, second last question. You're in a company that's doing very well, and the opportunity to sell comes at a very attractive price. How do you think about and assess kind of maybe slightly earlier liquidity and that opportunity?
Right, so good traders, so people who trade for a living, don't have emotions, but they know how to make money, right? So most people, if they're losing money, they tend to double down. Good traders ride their gains, so they don't sell their gains too early and cut their losses fast. So the optimal way to make these decisions actually is to ride your winners for a long time. You know, if you back a Deliveroo, which could be a 5, 10, 20 billion company, don't sell early. Now, I would temper that with, just being smart about where the markets are at. So Deliveroo was reported in the press, I can't comment, as being worth 2.5 billion. If I'm a seed investor in Deliveroo and I got a company that goes to 2.5 billion in 4 years, would I take a third off the table and repay my fund 1.5 times over? Yeah, probably. Because you don't want to be stupid around it, but I think the default should be ride your winners. The gains will surprise you in the long term. This is back to this argument of, you bought Amazon at the IPO and you held it to today and look where it's at, right? Nobody could have predicted that.
Mm-hmm. So think of the audience today. If you could leave them with one message that they go home with, what would that one message be?
That's an interesting question. So we met a number of people here that are, I guess, in traditional industries. And that know a lot actually about value creation, whether it's in shipping, hospitality, property. And I think there's still a tendency to look at technology as a sector. And the message I would probably leave you with is to say technology is coming everywhere. And, we are looking at companies in farming and agriculture that will change the way we raise animals and we run farms. So it is, in a way, your duty, I think, or your it's in your interest to inform yourself about technology and not consider it to be something that's outside of what you do. It's not. It's coming in every sector. So if I was running a wealth organization, a family office, I would say, go play. Because you cannot learn this thing from the outside. Go give money to Beko. Don't worry too much about losing it. You have to play the game. Now, I think, for example, Europe at the moment is particularly attractive because we're seeing mature exit markets, we're seeing valuations are still under control, we're seeing a lot of quality in the ecosystem. So as a way to start to play, provided you can partner with people who are transparent about the learnings, I would say, for example, you might actually get some pretty good returns there, as well as learning about the market. But the thing to remember is technology is coming for you if it's not already come for you, so go play the game, go learn. You can only learn from the inside.
Now I see blinking zeros on the timer. I'm not sure, do we have time for a Q&A, Danny? We do?
I think we do.
Great. So does anyone have any questions? Let's start over here.
Hi, thank you for a really enlightening session. As a board member, what, if any, differences have you seen between dealing with men and women entrepreneurs?
Well, we know that there is some very clear biases in behavior, typically, where there'll be patronizing attitudes. There will be, speaking over, etc. I mean, this behavior is clearly something that you see. I will tell you that the most impressive and successful females are people who make absolutely zero excuse for being who they are and being feminine, and it's just like, in your face, this is me. And whatever you like, you could be tall, small, petite, and it doesn't matter. It's like, be exactly who you are, and turn that weakness almost into that weakness being the perceived differences in the sexes here, turn that into an advantage. Just be absolutely unapologetic. But it's work in process. It happens all the time. And we know that. So have I witnessed this? Sure. And it's sometimes even the female venture partners that are on boards that get treated differently by company CEOs as well. And it's just something that now we have no excuse to say we're not aware, right? So we gotta all relearn the mechanisms by which we don't let this kind of shit happen. And I don't really have any advice because I'm not a woman, and that would be the wrong thing to do.
Well,
you got the mic, man. Go for it.
Okay. So tell us, I want the audience to know more about how you guys got together, because there is a nice story there. So maybe you can share that.
Well, this is an interesting one, because actually just before we were about to come on, I interviewed Fred for the first time for my podcast, The 20-Minute VC, almost, and we were talking about it 3 years ago, almost to the day. It was mid-November in 2015. And I interviewed him for the show, and it was the first time that we met in person. And I was at law school at the time, and after about an hour, it was pretty clear that this was someone who I wanted to spend more time with, and very nicely, he seemed to want to spend more time with me.
We literally, I didn't even let him leave the room. I'm like, you're staying here, I need to know more about you.
I'm going to be honest, I didn't need much convincing to miss a law seminar, so that was an easy one. And that was the start of it. It was a very obvious kind of fit and friendship from there, and has progressed, I think, really nicely over the last 3 years.
And fundraising, so fundraising for first-time funds is hard, right? And we have been fundraising as a first-time fund. We did a close above our minimum target recently. Fundraising brings you together if you're a good team. And I think we have been forged, through that process as a unit, in a way that's, I think we consider each other a family, we got each other's back. Like I said, we force each other to be better, but a very equal partnership despite the difference in age, and that was sort of grounded in shared experiences, and so it's been a great process, actually.
I have a follow-on, but I'll let somebody else ask. He has a mic.
I'm following your advice, old school bricks and mortar property developer, but I try and keep educated by attending Danny's and Amir's conference every year. So one of the last sessions was the AI selection of entrepreneurs, and do they tick the boxes and the likelihood of success. How much value do you attribute to that versus intuition, which in old school is still probably the main factor in an interview or trying to assess an opportunity?
So there are some very, very good tools, for example, in psychometrics, to be able to assess team and see whether people are going to fit within teams, etc. So it would be foolish to negate the science around this. And I think my comment earlier was to say, this is all helpful in aids to decision making. This notion that you can find, score, and more importantly, win the best deals purely by using data-enabled approaches is something that I think in early stage is a bit fanciful. And in part because of that notion of you need to get picked by the entrepreneur. And the entrepreneur doesn't want an AI investor. The entrepreneur wants someone who says, hey, dear Fred, we're going to be up shit creek for a year and a half because we have to do a massive pivot. Do you still believe in it? And that you can't AI that part away. So there is an element of faith. I would say, for me, I actually somewhat fall in love with the project / the entrepreneurs without overdoing that analogy, but there is an element of really wanting to be involved for a long period of your life and not wanting to give up until you've seen success. Now, at the same time, I have to be a rational portfolio investor, and I have to cut my losses if losses there are, etc. So, this is back to this schizophrenia argument. But, that part is this valuable bond between people who believe in a common project is something that you can't AI away.
We have a question over here.
Perfect.
Keep the mic with Kush. Go.
Hey, hello? Yeah. Fred and Harry, thanks very much. This has been brilliant.
Who's asking the question? I can't see you.
Here.
Oh, all right.
Alex.
Hey, man. Alex.
Co-founder Danny over here.
Yep.
Over the past 2 years, we've started to see some founders come from unconventional places. What can we do to get more of that? Whether it be a different country in Europe or abroad, whether it be a different university or school leavers or whatever it might be. What can we do to get more of these unconventional founders and interesting businesses coming ahead?
Why do you think I chose Harry as a partner?
Exactly.
University dropout.
What can we do to get more of that?
There is the Peter Thiel model. Look, this is hard, man. In fact, when you apply AI, where we talked about this before, what do you apply it to? Where people went to school, blah, blah, blah. So you're kind of reinforcing, unless you're explicit about it, you're sort of reinforcing this closed network approach. I think it's a hard problem to solve overall, and I think having more diversity funds, having people. I think it's great, that there's a new VC initiative for Black investors in the US. I think it's called Blacked or something like that. I mean, fantastic. By all means, go self-organize around whatever vector you want to sort of help make that happen. Because I do believe if it's not coming from the inside, it's harder. Now, we like unconventional people, we like dissenters, we like people who are self-taught. So we try and correct for that, but the reality is most of our deal flow comes from trusted sources, great universities, blah. It's like the reality of the world. There's a reason, by the way, why these universities are hard and expensive, etc., because they're great filters, right? So to a certain extent, we can't completely defy gravity. I think we just owe it to ourselves to have an open mind and look for raw talent and ignorance in a way is a beautiful thing. If you know too much about a sector, you don't disrupt it. So we're big believers in very young founders. We almost backed a guy who's 21 going after the sheet music industry, which he pretty much knows nothing about, and he's coming at it from a completely different angle with a CTO who the reason why he solved the technology problem is because he was a machine vision guy who came from a totally different industry and came with a novel approach. So this idea of taking orthogonal approaches to sectors you don't understand is very appealing to us.
So we got an industry here which is halfway through maturity where the VCs sometimes have a territorial play against each other. So what's your recommendation to LPs and the founders that have to play with this scenario?
I'm not sure I fully understand your question, I'm sorry.
We've probably got 5-6 large VCs here that have a territorial play. So sometimes there's conflict between the VCs when it comes to founders and LPs.
Yeah, I think that's a kind of an immaturity point in terms of market. And I would say if you think that's a real issue, expose it and kind of force people to change the behavior around it because you kind of get the ecosystem you deserve. Our view of the world is, we want as many good funds in market as possible. And we want them to be recognized for the good work that they do. And founders will decide who they want to work with. So, we've done things like we took some US investors over for dinners in the UK, and they were new to the European market. We say, why don't you meet all our competition? We'll get the best, not everybody actually, we'll get the best managers in the room, and you meet them all. And then you can decide where you put the money. Why? Because we thought it was more important for us to drive a new investor into our local ecosystem than to try and sort of jealously guard the lead, as it were, and kind of lose it because they hadn't met enough people. And they said, we need to meet more of the managers. We're like, great, we can make that happen. And then hoping they come back and give us the check after, which they haven't done yet, by the way. So, but that's okay, right? You got to play to win, and you have to recognize these ecosystems are only successful together. This notion that the zero-sum game does not exist. MENA region is in the early stages of building something meaningful, which means everybody will win if the ecosystem's good. I'm convinced of that. We've seen that everywhere. It is a connected global world where the sharing of knowledge, the sharing of leads, the sharing of money, makes everybody more successful. So I think, look, if you think it's a problem, get a bunch of entrepreneurs together and make it public. Shame them out of it.
Awesome. Last question right here.
Hi. What's your investment and decision-making process like before investing in portfolio companies?
You mean reinvesting or first investment?
First investment.
I mean, you want the real answer? We're super busy, we're running around, we got a bunch of deals, then one of them looks really hot, and we're like, okay, we're gonna blow the agenda open so that we can focus on that one company. We then hunt as a team, we spend as much time on it as we can, we talk to as many people as we can, and we continue doing that until we get to the point where we have effectively made a decision to come in. Very early on, we'll talk about deal terms. Like literally after the second meeting, if we think something's amazing, we'll put deal terms on the table. Why? Because we just need to find if we've got alignment on there, and we also want the founder to know what they're working towards, right? So in a spirit of mutual transparency. So then decision making is, we look for greatness, right? We do not put ourselves under any pressure to invest ever. It's okay to be slow. In fact, it's better to be slow than fast. So then we're sort of trying to have a mental yardstick that says, does this thing belong in the portfolio? We want a label of quality around the things that we do, and we want extremely high upside deals. And so this is where we're trying to assess, and there's no perfect way to do this, but is this of the quality that we want to attach with the brand, right? And never, ever put yourself under a pressure to deploy money, ever. It is totally okay not to invest for 6 months. I mean, that's pretty much how it works, man. And then, we look explicitly at a bunch of things that go into our investment memo, but I mean, that's kind of standard. What I've learned is, so discipline does help and matter. And so what we're trying to do is to do a lot of work ourselves without overloading the company, and then doing the sort of gradual information discovery with the company. So at every time we meet founders, we'll say, okay, what's the next most useful step we can do to get closer to a yes? So we don't throw them due diligence requests that are like 3 pages long. We're like, what is the most useful thing we can do to get closer to a decision so that we keep the overhead on the company low? Because we're very cognizant of their time, especially when they're fundraising, if that makes sense.
Okay.
Right. I think we're done, right?
Well done.
Can I have the closing word?
Sure.
Is that all right? I'm going to make you guys clap again when we're finished, so you can stop clapping. So a week ago, I was copied on an email that Fred had written to somebody in the region about what they were up to. It wasn't a marketing document, it wasn't a deck, it was just an email. Here's what we're up to. And I've seen, and we've seen hundreds of these things, and decks of peer VCs all over the world that they share them with us voluntarily. So this is not even a deck, this is just an email. And it was probably 4 or 5 bullets talking about Stride. And honestly, all I could think at the end of it was, where do I send you the check? It was just brilliant. And this is just testimony. Thank you so much for your candor and this wonderful show. A round of applause again, everyone.
Thank you.